Oh, that's Elizabeth.
Wouldn't we all die for that kitchen?
Hi, everyone. Thank you so much for your patience. Elizabeth, we are all admiring your kitchen. Thank you so much, Brenda Trigo with VB Realty Group. Really excited to have great speakers. Thank you, Robert Iso from the Tax Assessor's Office for taking the time to be here. We also have Brian, an amazing real estate attorney, to answer a lot of questions that we have. So thank you for those of you that are here in person, enjoying some Hawaiian food, and for those of you at home. So we'll start with, yes, we're going to do Q&A at the end. If you have any questions, you can put them in the chat. Otherwise, wait and we will answer them at the end. Yes. We are recording this session. Robert, you're up. We're going to start, just so you know, we will screen share.
Okay. Hi, good afternoon, everyone. My name is Robert Isozaki. I work at the LA County Assessor's Office. So I've been asked to come here today and speak on a number of topics that our office addresses. First, I'll go through an office and role overview, or the tax roll overview. One of the big things that I'm here to talk about today is Prop 19, some of the recent changes in the law. A couple smaller issues, the homeowners exemption and accessory dwelling units, also kind of hot topic issues at the moment too, but we'll go through these in order and let's get started. So when I do the office and role overview, typically what I like to call it is the who, what, where, when, and why of the LA County property taxes. So the when is Prop 13, which is kind of the bedrock of California property taxation. Who, LA County property tax departments, who's involved in the property tax system in our county. I know that there's probably a number of you out there who deal in Orange County property too. The law is the same across the state, so that's not going to change anything. The departments from county to county might a little bit. What real and personal property that's taxed in LA County, where, again, LA County, and why, the assessment role. So we'll start with Prop 19 or Prop 13. Under Prop 13, the assessed value of your property can increase a maximum of 2% each year. However, property can get reassessed upon two main events. One is change in ownership, when you transfer it via a deed or you pass away and hand it down to your kids, things like that. Also, when there is new construction that occurs in the property, you decide to add a pool, a new bedroom, something like that, we'll go in and reassess the new square footage or whatever benefit that new construction adds to the property. So what are the departments within LA County, at least, that contribute to you getting a tax bill every year? It starts in two main places. What are the sources of information that the assessor's office relies upon? The first is the Registrar Recorder County Clerk's Office. They receive all documents that pertain to transfers of property, things like deeds, affidavits, death of property owners, things like that. Those deeds and affidavits get sent to the assessor's office, where we determine whether or not the transfer that are evidenced by those documents should result in reassessments of the property. Like we talked about earlier, when new construction occurs, city and county building and safety departments issue permits, and they also send copies of those to our office so that we can determine we can find out if there's new construction occurring at a property and whether or not that needs to be reassessed. Like I said, all that documentation comes to the assessor's office so that we can determine what the appropriate value of a property is. When we come up with those values, we send them over to the auditor controller's office. They apply the applicable tax rates to those values, and that's what ends up on your tax bill. Those bills are sent out by the treasurer tax collector's office. They also collect your payments. I included a sixth office here. It's the Assessment Appeals Board. It's a body that is run by the County Board of Supervisors. And essentially, when you have a dispute as to your assessed value, I know I got reassessed, but I think that the property value that the assessor placed on my property is too high. You can take that and apply to the Assessment Appeals Board. They're a third party from the assessor's office and the property owner, so they're kind of like a pseudo judicial court-like setting where you come in and argue what you think your property's worth. The assessor's office will defend its value of what your property's worth. So that's something to keep in mind if you ever think you're being taxed a little bit too much. In addition, if there's ever a correction to your value where your assessed value goes down and your taxes have gone down, but you've already paid on the higher tax amount, the auditor controller's office is the one that's going to send out the refund. So oftentimes we'll get calls at our office. Why am I being taxed so much? When am I going to get my refunds? So this is kind of a handy guide to who you can be contacting for your specific issues. So that's always a little bit helpful. The what of LA County property taxation. So what is it that we value at our office? It's real property and personal property in general. So real property is things like you'd expect: residential homes, commercial property, industrial property, warehouses, apartment buildings, condos, things like that. We also value things called business personal property, things like furniture, equipment, machinery that business owners use to conduct their business. You'll also see up here pictures of boats, aircrafts, and racehorses. They're not considered necessarily business personal property in all cases, but they are taxable personal property nonetheless. So those are things that our office assesses as well. Why do we do this? It's to put together what we call the assessment roll. So the roll is an inventory of all taxable property within LA County. So that, again, that's real property and personal property. It's important because it serves as a planning document for local government agencies when they're putting together their budgets. They know how much they're going to have coming in, so they can determine how much they can pay out. And the roll also serves as kind of a metric on how the local real estate market is going. So right about now, we're finishing up our assessments for the 2022 tax year, but we don't quite have all that information in. But last year, 2021, we experienced the 11th consecutive year of growth since the Great Recession in 2008. According to some of the forecasts that we have, we're projecting that this year is going to be the 12th year of consecutive growth. So that's a good sign. For 2021, we saw the roll grow to $62.9 billion. That's a 3.7% increase over last year. And that stands for $1.76 trillion in assessed property. So all of the property that we assessed in LA County, it comes out to this $1.76 trillion figure. And again, this year we project that it's going to increase a little bit more as well. And then again, this represents 2.5 million assessments. So that's the real property assessments and business personal property assessments in LA County. We know that we've seen in the last couple of years that the housing market has been booming. Part of the reason for that, as you probably are well aware, is the limited inventory, but also the low mortgage interest rates. But as we've seen in the last couple of months, those are beginning to creep up again too. So we'll see how that affects things as well. Okay, so kind of what we're all here to talk about today, Prop 19. So it was approved by California voters in November of 2020, and it made changes to two main components of California property taxation. So the first thing it did was it expanded the existing benefits for seniors, property owners with disabilities, and victims of natural disasters and wildfires. That became effective in April of 2021. That expanded benefits, so people were very happy about that, but the other component, the second one, is something that has caused a little bit of distress among property owners. And that, what it did was it restricted existing benefits for transfers between parents and children, and the benefits that existed for some transfers between grandparents and grandchildren. That came into effect on February 16th of 2021. So we'll start with the component that seems to have made a lot of people happy. Base year value transfers. Under the old law, you were only able to transfer your property to, or transfer your tax base to a replacement property in about 1 of 10 participating counties. Now you can transfer it to a replacement property located anywhere in the state. It's not limited geographically. In addition, under the old law, you were only able to take advantage of this benefit once. There was a limited exception where you could take advantage of it 2 times, but again, that was very limited. Now, property owners can take advantage of it up to 3 times. And then finally, from my experience in the assessor's office, one of the benefits that is under Prop 19 that changed from the old law is now you're able to buy a replacement property of any value and transfer your tax base to it. Under the old law, you had to purchase a replacement property of equal or lesser value. So if you purchased a more expensive property under the old law, you were kind of out of luck. Now, the new law kind of makes some wiggle room for that. One thing that I will say, though, is if you do ultimately purchase a replacement property that is of greater value than the property that you sell, there will be an upward adjustment. Essentially, we'll take the difference in fair market value between the original property that you sold and the replacement property that you purchased, and we'll tack that on top of the tax base that you move over. So you're still probably getting a benefit. It's just we have to make that adjustment since you're kind of upgrading your home at that point. Now on to intergenerational transfers. This is the part that I said has been problematic for a long time. So what have been the changes under this? How has it restricted the benefits under the old law? So one kind of expansion is under the old law, we saw that you were able to transfer property and your tax base from parents to children, also from children to parents, but it was a one-way deal for grandparents and grandchildren. If you were a grandparent, you could transfer your tax base down to your grandchild. The grandchild could not do the same up to the grandparent. Under the new law, the way that it's written, it states that transfers between grandparents and grandchildren are eligible for this benefit. So we've interpreted this, and the Board of Equalization has interpreted this to mean that those transfers, base year value transfers, can go both ways. The exclusion, however, now applies only to a principal residence of the person who's transferring the property. Under the old law, you could transfer your principal residence as well as $1 million in additional property. So if you had a vacation home, other rental property, things like that, you could transfer up to $1 million in extra property. That no longer applies. You can only transfer your principal residence now along with the tax base. We'll get to that in a minute. We will revisit that because there is a caveat to that. Also, though, under the old law, you could transfer your property to your, say, a parent could transfer their property down to their child, and the child could inherit it or receive it and begin to use it as rental property, for example. Keep the home that they've been living in, the property that they get from mom and dad, they could rent out. Now, that property must become the child's principal residence within 1 year of the transfer date. They have to file a parent-child transfer or a homeowner's exemption claim form or a disabled veteran's exemption claim form within 1 year of that transfer as well. So that's a hard and fast rule as far as we know right now. I know that there has been discussions at the BOE as to whether or not they're going to be able to create some wiggle room. But as of right now, without any additional guidance, the law states that if you don't file that homeowner's exemption claim within 1 year of the transfer, even if you were to file your claim afterwards, there is no benefit that can be had, whether it be retroactive or prospective. So again, under the old law, if you filed your claim form late, not within some of the prescribed filing periods, you could get prospective relief beginning in the year that you filed your claim. Now, if you don't file your homeowner's exemption claim on time, you're kind of out of luck. So it's as you can see by all of these, it severely restricts what was available under the old law. On to more unhappy news. When you transfer your property down to your child, your principal residence even, under the old law, your home could be of any value and you could transfer it down and the property wouldn't get reassessed. Now there is a $1 million factor that is taken into account. So I tried to simplify it here, but essentially if the fair market value of the property at the time of the transfer is over $1 million, we have to start taking some additional factors into consideration. So the rule of thumb is if your property is worth less than $1 million at the time of the transfer, you can transfer your home to your kids and there won't be any reassessment. But if the property is worth more than $1 million at that point, we have to undertake this value comparison test. Essentially, what your child what they'll be paying their taxes on moving forward is going to be the greater of two values. Either the property's current trended tax base, which is what their parents have been paying on, or the fair market value of the property less $1 million. So whichever of those two is greater, that's what the child will be able to have moving forward. I know that's complicated. I'm going to talk in a couple seconds about some of the resources that the assessor's office has put together to kind of help with some of these more complicated formulas. But that is one of the main restrictions that's been placed on parent-child transfers. So like I was saying, we put together a dedicated Prop 19 webpage. It has all the information that I've talked about today, some fact sheets that you can print out and provide to your clients if they have questions about either the base year value transfer or the intergenerational components of this. If they're making plans and kind of want to figure out how these would factor into that. But one of the things that we're most proud of are these Prop 19 calculators. So essentially, all you would have to do is input the assessor identification number for the property in question, and then some fair market value information. Hit calculate, and that should provide you with the tax base that either the person who's taking the base year value transfer program or the inheritor of property would have moving forward. So again, I would highly encourage you to take a look at this webpage and take it and just mess around with the calculators a little bit. I think it's a very helpful tool. So the homeowner's exemption. In the past, when we used to present on this, we would highlight that it's something that you can take advantage of if you own your home. It's free. You just apply once, and if you're living there and it's your principal residence, it's $7,000 off your assessed value every year. Roughly, that translates to about $70 in tax savings each year. So it's not a whole lot of money, but in this day and age, I think any amount of money that you can save is a benefit. Again, there's no charge, and once you have it on your property, we won't remove it until you move or you request that it be removed. So sometimes people wonder, oh, it's a benefit to me to have this on my property. Why would I ever ask to have this removed? So sometimes people purchase new property. They like that property. They like that second property more. They decide they want to move into it. At that point, they'll want to request that the homeowner's exemption be removed from that first house and placed on the new property that they purchased. So that's kind of the instance in which we see people removing it. It's not so much they're getting rid of it entirely, but they're just moving it from one property to another. Oh, and a key thing is if you're a new homeowner, it's going to get sent, a claim form is going to be sent to you right away. All you have to do is fill it out and mail it back in. At this point, we do still require wet signatures, so it will have to be mailed in. We're hoping in the future that we'll be able to change that, but at the moment, that's still kind of our procedures for that. Sometimes people wonder, oh, I'm not sure if I have this being applied to my home or my property. So if you take a look at your tax bill, over here we have a green star. It says less exemption, and next to that, if you have the homeowner's exemption, it's going to say $7,000. And so if it's not there, this individual does not have the homeowner's exemption. So what they would do is they can just go to our website, download the form, print it out, sign it, send it in, and next year they'll be able to have the homeowner's exemption applied. And so the net taxable value will be $7,000 less than the total figure that you see there. Another way, if you don't have your tax bill on hand, but you want to see if your property is receiving it, you can take a look on our website, assessor.lacounty.gov. On the homepage, there's a property search function. You would just insert input either your address, or if you know it, your assessor identification number. It's the 10-digit number that we use to identify your property. You type it in, it'll bring up the page for your particular property. If you see next to these red arrows, again, there's an item or a field that says exemption. If you have nothing there, you're not receiving the benefit. If you are receiving the homeowner's exemption, it will say so next to it. So as you can see here on the left, no homeowner's exemption identified as being associated with this property, but on the right, this person is enjoying that benefit. Again, like I said in the past, the significance was this $7,000 benefit, but now because of Prop 19, like I was saying earlier, if you don't file that within 1 year of the transfer involving the parent-child, grandparent-grandchild benefit, you're going to be out of luck. So it's going to be important to keep that in mind when these types of transactions are going on, because although in a certain sense and generally it's a very small benefit, it can prevent you from taking advantage of a very large benefit ultimately if you're not aware of it. So something to keep in mind and something to remind your clients of. So we're not the tax collector's office. As I pointed out, we don't send out bills, we don't collect payments or issue refunds. But what I have here on the screen is an example of a tax bill, because we get a lot of questions at our office. When people receive increases in their taxes, they're not sure whether it was our office or some other office that did something that caused that. Oftentimes, it can be a result of a reassessment. It may also be a result of other factors. So in our presentations, we've started to kind of give a brief overview of how the tax bill is laid out. So where does our job come into effect? It's really with item number 1, the general tax levy. So like I said, we come up with the value of your property, we send it to the auditor, and they apply the applicable tax rate. And so that general levy is 1%. That's what we're allowed to tax. That's what property taxes are capped at under Prop 19 or Prop 13. In addition, though, if you look at your general tax rate, it's going to be usually about 1.2, 1.25. And that takes into account these other voted indebtedness figures. And so those are ad valorem taxes as well. The thing that I said, or the items that I said might cause a spike in your taxes is if there's been an increase or an addition of a direct assessment to your taxes. So your tax bill is made up of not only just your property taxes, but these other items called direct assessments. So those are items that are placed on the bill by other local government and public agencies. Things that relate to like mosquito control vector, emergency services, flood control, items like that or appear there. Brush clearance, things like that. So these other government agencies, they come up with these kind of charge or tax amounts, and they are allowed to put on the tax bill. So if you see a spike, you might want to take a look in that particular category first. If there's a something $100 figure that wasn't there before, that may be what is causing the increase. Again, you're always welcome to reach out to our office. Again, increases do result as from reassessments too. So we'd be happy to take a look and see if that's the case with your property as well. The final topic that we'll talk about are accessory dwelling units. It's something that's kind of become a hot topic issue because of SB 9 that's passed recently, which essentially allows you to split up your property using lot splits and then adding additional accessory dwelling units to your property. So when you add an accessory dwelling unit or ADU to your property, what's going to happen? So it's essentially, in our eyes, it's very simply new construction. It's a fancy name for new construction. You're adding new improvements to your property. So when we're informed that that has occurred, we're going to go in and assess the value. So when there is a new construction reassessment, people wonder, is my whole property getting reassessed or just part of it? Essentially, what we do is we value the cost to create that new improvement or ADU, and we add that on top of your existing assessed value. So if you had a home there and the land. So we're not reassessing your home or principal residence. We're not assessing the land. It's just essentially in addition to what was there before. So we do have information on this on our website about this. We also did have a handy a webinar recently where we talked with the county building and safety and planning departments. And so they went through some of the processes that their offices go through when it comes to the planning process. Our staff talked about the reassessment process. And we also had SoCal Edison come in because when you do create or build an accessory dwelling unit, there are certain electrical requirements too. So they gave some insights into what their office is responsible for. So I would encourage you to go take a look at that. As far as we value our relationship with our real estate partners. So the assessor has been very proactive in putting together what he likes to call the real estate toolkit. It covers basically anything that you would want to know. Things involving wills and trusts in a general way, what new homeowners can expect, supplemental property tax calculator. There was one other one, refinancing. We get a lot of questions on, oh, if I do take this particular action in connection with my refinancing efforts, am I going to get reassessed? The short answer is maybe. In that particular section, we lay out a lot of the scenarios, co-signers, things like that. That's been very helpful to a lot of people, so that not after something has happened and they're already in trouble, but when they're planning their refinancing, they can take a look at that and see, oh, what is the way that I can potentially avoid this reassessment? And so again, there's a lot of more topics than what I mentioned, but I would encourage you to take a look and see what that has to offer. So that wraps up my kind of overview of our office and some of the changes in the law. I've included our contact information here, as well as a link and information for the tax collector, because again, a lot of the questions that we have are questions that the tax collector is really going to be better equipped to address. But If we have any questions, I understand we're going to take that at the very end, but again, thank you for having us. We're happy to answer any questions at the end.
Well, thank you everyone for having me. My name is Brian Harpst, and Frank, that was a great presentation. I'd like to echo some of the things he indicated. Roughly a year and a half ago, when it became clear Prop 19 was coming down the pike, basically everyone in my industry, I'm a tax attorney, none of us had really any idea what it meant. It felt very accelerated. The law was not clear, and frankly, I think a lot of the county assessors were very confused as to what it meant as well. Board of Equalization didn't have a lot of answers, and the LA County assessor had the best content online helping us decode and try to figure out Prop 19. And that remains the case. If you have questions about Prop 19 or other property tax issues, you can go to any county website in the state. LA County has the best information. So that's the absolute best starting point to learn from. And it saved a lot of us a lot of time researching and reading law last year, which we appreciate. Because fun fact about attorneys, we don't like reading the law any more than you do. So it was nice to have someone help us out with that homework. So I'm also going to talk about Prop 19 along with Frank. He had some wonderful content information. So I apologize if any of this is repetitive, but it's incredibly important. So, practice makes perfect. We're going to hear some of this stuff twice. So that's me. I am delighted that I just realized I was not wearing the same suit today as I was in that picture. I'm a tax attorney. Basically what that means is I help people with their legal affairs to manage their income, estate, and property taxes in the most efficient way. And property taxes are often one of the issues that really just slip through the cracks. People don't realize how important property taxes are until they've made a mistake, and sometimes we cannot fix them. So I'm really happy to be here, paving the way and maybe giving you guys a better understanding how to avoid pitfalls before they happen. So in a nutshell, the way California property taxes work is we have an assessed value of property. Oftentimes it begins with a purchase price. Then every year, because property has been increasing, as Frank indicated, the last 11 years, there's a readjustment based on the increase in value. That creates the adjusted assessed value multiplied by the tax rate. That's how you get your bill in a nutshell. There's a lot more minutia to it, but I'm not going to try to make you guys tax attorneys right now. But generally understand that's how it works. Now, Prop 13, this is a great one because I will say this is the only taxpayer-friendly law we have in the entire state of California. So it's really easy to remember. And basically what it says is your home may go up 30% in value every year. They can only raise your property taxes based on a 2% increase. And as we know, since 1978, when this law first came into being, home increases on an annualized basis have outpaced 2%. So there's been a major boon for taxpayers in that the amount they're paying in property taxes on their home is far less than what its current fair market value is. It's a good thing. That's why I say it's easy to remember, because it's the only taxpayer-friendly law we have here. And this is just a general chart kind of underscoring the impact. So if you look at the first column right here with the 10 million, that's a $10 million purchase price. And it assumes 10 years later, the home is worth 14 million. But the Prop 13 basis is only 12. And then when we get to 30 years, we've got 33 million versus 18, creates a tax bill, and these are huge numbers, I know, but indulge me, 184,000 versus 336. So almost a 50% reduction in taxes thanks to Prop 13. Now, one of the great things about the old law was that, as Frank said, when a parent was transferring their home to, it's Robert? Darn it. I probably said that 10 times, haven't I? Frank's a lovely name. Robert's better though, I apologize. So essentially, when a parent transferred their home to their children, either via inheritance or lifetime transfer, if it was the principal residence, there was no reassessment regardless of the value of the home. You could have transferred Hearst Castle to your kid via lifetime or testamentary transfer, no change in property taxes. It is a wonderful thing. Now, important to remember, that says old law because it's all going to change. Additionally, in addition to Hearst Castle, you could transfer up to another $1 million worth of other property to your kids. Again, no increase in property taxes. And that $1 million was not fair market value, it was Prop 13 value. So it's even better than it sounds. Again, it's all gone. Sorry, guys. Prop 19 came out about a year and a half ago. Essentially, what it does is it changes that parent-child exclusion that I said was so generous. First thing it did was those extra properties that were not principal residence, they're gone. This only applies to principal residence now. In addition, as Robert said, it's only up to the first 1 million. So if your transfer property, the principal residence is worth less than $1 million, we're fine. If it's worth more than $1 million, that additional excess over 1 million is added to the tax base. So there's going to be an increase if that's the case. Also, the child has to move into the home within 1 year while the homeowner is exemption. There's a lot more to it. Before, if it was just a principal residence, you didn't have to move into it. As long as there's a principal, it applied. So there's a lot more that came along with Prop 19 that significantly limited the parent-child transfer exclusion. For better or worse, doesn't matter. It just is what it is. And this applies to transfers going forward from February 16th, 2021. Prior to that date, I'm sure you heard from your people at the recorder's office, there was a boon of transfers that occurred to try to get through it. I was up for weeks. I'm happy it's all behind me. The problems with Prop 19 is that I think a lot of us would agree that it was very vaguely and poorly written. For example, if you move into the home and file the homeowner's exemption within 1 year, you qualify. How long do I have to stay there? Can I move out the very next day? Robert, has there been guidance there? So our understanding, but we don't know because they haven't written down the law. Additionally, what if there's a couple kids? I have a sister. Do we both have to move into the home? I love my sister. I don't want to live with my sister. Robert, have they? Okay, that's wonderful. Okay, so what Robert is indicating is the Board of Equalization, and I wasn't aware of this, so thank you, has cleared up the issue about multiple people inheriting the same property, multiple siblings, that is. Instead of you having to live with your sibling, now as long as one of them moves in and it's qualifying event, then the Prop 13 tax basis transfers. That's wonderful news. So as I said, to understand the new changes to Prop 19, you basically have to understand the old rules. The old rules were very generous, allowed a transfer of the principal residence, regardless of value, to children without any requirement that they move into it. It also allowed transfers over properties up to $1 million in tax basis. Again, they didn't have to be principal residence, they didn't have to be anything. You just got it. Now, it's got to be a principal residence. The child has to move into it and file the homeowner's exemption with 1 year. It's got to be worth less than $1 million. And if it's worth more than $1 million, there's the additional taxes on top of it. So in my practice, as I indicated, I'm a tax attorney. I do lots of wills, trust, probate work. We're talking with real estate agents. I'm sure many of you have encountered title issues in escrow. That's one of the times when I come in and try to help. And these are issues that come up is what's going to happen with the tax base. So the reality is the laws still exist. There is still a safe path to maintain a transfer or Prop 13 tax basis and an inherited or transfer property. It's just a lot harder to navigate now. Whereas before, I think we would all agree is relatively simple. But that's the world we're living in now. So it is what it is. So with that, I really appreciate everyone's time. Like I said, I hope I've given you just a general overview. I'm not trying to make you tax attorneys here. Lord knows there are days I wish I wasn't a tax attorney, so I wouldn't try to impose that on all of you guys, but that's generally what we're dealing with is there's still a safe harbor. You just have to navigate your way there with a little more caution than you did before. Okay. Robert, I have no idea what I said.
They're both cool names. Yeah. We're ready for questions if you have any questions. Okay, one question. Will the $1 million amount be adjusted over time, or will that require a new proposition?
So that $1 million allowance that we were talking about with the principal residence, that has it has been written into law that it will have an escalator clause, or it will be increased over time. And I believe that's going to be up to the BOE. They're going to have a certain metric that they follow for that.
Date of death. So I have someone that situation happened. They moved into this home. She passed away 3 years ago before Prop 19. How does he handle that?
Now you have time limits to get the parent-child decision filed. So it's typically 3 years, but there's also an extension. Hasn't been a supplemental or escape assessment. So generally speaking, unless there's been a notice of reassessment, they probably still have time to fix it. Unless there's been a notice of reassessment via escape or supplemental, there's probably time to fix it. Even if there has been a notice of reassessment, you can still file and get prospective relief. Yes, so as long as the date of death was prior to the February 16th, 2021, old rules apply.
Yes, we are recording the presentation, and anyone that's here or on, we will send you a copy of it.
Sure. I recently heard from an attorney that if you transfer from grandparent to grandchild or grandchild to grandparent, that the parent in between has to be deceased. Is that correct? Okay.
That is correct. One more question.
Okay, I have a few questions, please, and forgive me. I'm probably the only person, I'm sure I'm the only person in here that was around for Prop 13, 1978. Yes, I voted for it. And I didn't really know what I voted for, but they said it was good from the people I talked with. Yeah, I had just gotten out of school back then. So at 67, I refused to grow up now. So the question I have, Robert / Frank, no pun intended, is the first question is back in 2008, you mentioned about Prop 13. That was the last time, I guess, that something happened that was different, because every year it's been following. Does that mean it didn't go up like 1 or 1.2 or up to a maximum 2% back in 2008?
So what I was saying about Prop 13, it's still in effect, but what happened in 2008 was the market value of a lot of homes dropped below the assessed value. And so when we placed all of our values on the roll, it was less than 2007. And so that's why we saw a dip. If you looked at the total budget for LA County based on, or the revenue that we got from property taxes that year, it was going to be less than it was the year prior. Every year since then, we've seen that that revenue going up and up. So that's a good thing. Yeah, so that year, it was 2008, the revenue that the county obtained from property taxes was less than it had been in 2007. Now, when it comes to like individual properties, if in a given year, and usually it's in down market years, if your assessed value is, or I'm sorry, your tax base, your Prop 13 tax base is higher than the fair market value of the property, you can apply for what's called a Prop 8 decline in value. It means that it means exactly that you should be paying taxes on a lower market value as opposed to your Prop 13 value, which is creeping up gradually every year. Right, and yeah, sure. And so you said that in 2008, you went to the assessor's satellite office. You had a question about why your assessed value was less than it had been in prior years. And again, like we were talking about, because the market had dipped so low, And because the way that Prop 13 is written and what we're required to do when it drops that low, that's why for that particular year, you saw a decrease in your taxes. Each year since then, you've probably been seeing an increase, and probably will continue to see that until and unless there's another giant dip in the market. Yeah. Yeah. It is. Right. Right. I wouldn't hold your breath. Okay, so again, the question is, my parents thought Prop 13 was terrible for California. Won't this represent a loss for revenue for California? So Prop 13, like we were talking about, is kind of the umbrella law for all of California property taxation. So that was the one that was passed back in 1978. It protects homeowners from drastic increases in their property taxes. I may be misinterpreting this, but what this may be saying is that they thought that Prop 19, the more recent law that was passed in 2020, is detrimental. So I was having this discussion a little bit earlier. Our understanding at the assessor's office, and this is more of a policy question that we're not necessarily privy to the inner workings of, but our understanding is because this base year value transfer component was likely going to bring tax revenue down, that's why we saw a restriction on the parent-child or intergenerational transfer component. So people will be saving less money on parent-child transfers, but they'll be saving more money. Seniors will be saving more money when they move their tax base around. So those two kind of conflicting components were ultimately supposed to level out the effects that we would see on property tax revenue. So yeah, again, people were unhappy with it, but for different reasons. But that's generally my understanding and our office's understanding of how those two components were supposed to interplay.
Yeah, I mean, that's kind of a policy-based question, and like Robert, I don't know how the sausage was made there, but I think generally speaking, on the back end, when people start passing away, unfortunately, and homes become transferred to the next generation, there's going to be an increase in reassessment of Prop 13 bases, and based upon when a property was home, baby boomer generation, and the increase in properties since then, those are going to be significant. So whether or not that's going to be a net boon or loss from the state is difficult to say, but most definitely on the back end, there is going to be a significant increase in property taxes. I mean, yeah, so now that's a bit of a policy-based question, and I was 1 year old in 1978, so I had other worries, but I definitely think there's truth to that. It did cost the state of California a lot of money in property tax revenue. Whether or not you think is a good or a bad thing really is more of a personal policy-based question. Yeah.
We've got another question.
Robert, back to you. Okay, so as you're going through your slides, and respective, I wrote something down here, but you mentioned something about a replacement in one of your slides. The replacement of the principal home. Explain that again, and how does that work?
So what I was talking about was Prop 19. It's called a base year value transfer. So say you're 55 and older, you own your home, but you want to move to a different home, be closer to your kids, grandkids, what have you. You can, under Prop 19, take the lower tax base, your base year value from your current home, and when you purchase that new home, move it over. So say you're paying taxes on $400,000. That's what we've assessed your current home at. You decide that you purchase a new property, sell the home you're living in now, purchase a new property at $1 million. Again, this gets into math a little bit. So let me start over. You live in the home now. It's currently worth, the fair market value of it is $800,000. You are paying taxes though on $400,000. That's what you purchased it for, plus that 2% Prop 13 increase. You sell it for $800,000 and you purchase a replacement property for $1 million. You can transfer over that $400,000 tax base from the original home to your new replacement home. In this case, because the new home is more expensive than what you sold the original home for, we'll take that difference, $200,000, the difference between $800,000 and $1 million, and tack it on to the base year value that you moved over. So instead of paying property taxes now on $1 million, your purchase price, you'll be paying on $600,000, your old tax base plus the difference.
I might also add, the old law was you could only do this within certain counties in California. Now it's statewide. And the new homes got to be purchased either 2 years before or after you sell the old home. So that's liberalized the intra and extra county transfers significantly.
Real life experience. We've helped quite a few clients move out of LA County into Riverside County, vice versa, and transfer their tax base. And it's been really successful and seamless, no issues. Yeah, it's pretty awesome. Another question I'm walking over.
It's only in the state of California, though.
Yes, only in the state of California. Any other questions? That's good. No, that's great.
That's
Thank
why
you.
I came here.
Yeah, that's awesome.
Keep you all busy, you know?
Yeah.
Okay, so the last part of your presentation, Robert, when you mentioned about kids, okay, at 67, my wife and I have a son that's 43 and a daughter that's 36. So we've already told them, this house, when we're out, you're in, okay, that's it. And one of them has said, yeah, I think I want to live there and probably buy out the other, which sounds like it fits into what you presented. See, you're smiling, I could tell. That's good. But I guess my question is I have to file to do this exemption first. Is that correct? In order to get the benefit for me until it's sold?
Yeah, I'm walking over for the answer.
So if you own your home right now and you don't intend on passing it along to your kids until you pass away, there's nothing really that you need to do at this point. You're just going to continue to have your Prop 13 base year value moving forward, unless, again, there's some kind of transfer or some kind of new construction. What you're talking about, though, is when you your property is passed down to your kids, and Brian, you might have a better insight into the pro rata and non pro rata. Yeah. It does get very complicated, but essentially it comes down to if your property is held in the trust, how it's worded. And so I don't know if you want to touch on this a little bit more. But
I'll be happy to. It's very complicated. I'll simply say that. The problem with this is it seems simple. So in your situation, and indulge me, I do not know what your plan is, but I'm going to imagine it says equally between your children. And the idea is one child wants to live there and will purchase the other one out. If that happens after the deed has been prepared, there will be a reassessment because that is technically a sibling to sibling transfer and not a parent to child. So what has to occur is before anything gets done, you need to sit down with a competent attorney and CPA, or they do, excuse me, competent attorney and CPA to make sure that the transfer is structured such that it remains a parent-child and not a sibling to sibling.
Have him call Brian. Okay, I've got another question. I'm walking over.
Yeah, on the same topic, my sister and I had a similar situation, but in order for us to not have a reassessment of that property, my mother had to leave us an amount of money that I could buy her out with assets in kind. I guess that's what the term was at the time. So I think that's where in his case, he might run into problems.
So in the situation where there are other real estate or liquid assets such that the equalization can occur, between the siblings. For example, if you have $1 million home and $1 million in cash, and the idea is, well, I'll just take the home, you take the cash. As long as the trust allows for non-pro rata distributions, you're going to be okay. But in the situation, which is very common out here, where the home, the piece of real estate, makes up the lion's share of the value of the estate, that's not mathematically possible. Now, we can still accomplish the retention of the Prop 13 via parent-child, but it's very complicated, and that's where you really just need to sit down. So essentially what it comes down to is, if you've got more than one kid and you've got a piece of real estate with Prop 13, advise them before they do anything after you pass away to sit down and make sure that it's done correctly.
Okay, one in the chat. Can a person have multiple properties with the homeowner's exemption, or is it limited to one for the principal residence?
So for the purposes of the homeowner's exemption, only one home can constitute the principal residence. So you may split your time between a number of homes, but the one that you essentially intend to return to time and time again is what you probably should be filing your homeowner's exemption claim on.
Another question over here.
Talk of Proposition 13 demise, or them taking it away from or disallowing it at any time?
Our office has not heard anything to that effect. I mean, I'm sure that there are initiatives going around all the time, but with regard to how much weight they carry, I'm just not sure.
I think that's coming. I think Prop 19, while sitting on stools here, sawed off one of the legs of the Prop 13 stool in a major way. Like I said, as a back end, when people pass away, inherit that, the lion's share of situations is gone. I don't know if there will be a direct attempt to repeal Prop 13. There was a couple of years ago, and it didn't go through. So I think they got a little more creative with Prop 19 and removing the parent-child, or at least limiting the parent-child. So I don't think you'll see a full-on frontal attack of Prop 13, but I think you'll see ancillary things like this baked into other laws that are going to erode Prop 13.
Any other questions? Well, thank you so much, Robert and Brian, for coming out. We will send, if you guys are okay with sharing the slide presentations. Okay, and we'll send that out to everybody along with the Zoom recording. Thank you for everyone that's home and that joined us. Thank you for joining, and everyone that came out to join us here. You guys are going to be here for a little bit to answer any other questions. Okay, thank you. Thank you so much. Good night, everybody.